A tariff is a tax imposed by a government on imported goods or services. Its primary purposes are to generate revenue for the government, protect domestic industries from foreign competition, and influence trade relations. Here's how tariffs function in practice. A tariff is a charge on goods that are brought into a country, imports. It can be seen as a tax on the importer of the goods, which then often gets passed on to the consumer in the form of higher prices. Importer pays. When goods arrive at the border, the importer, the business or individual bringing goods into the country, is typically responsible for paying the tariff. Customs authorities. The country's customs office determines the applicable tariff based on the value, type, and origin of the imported goods. Customs also assesses whether the goods meet the import regulations of the country. There are a few common types of tariffs. Ad valorem tariffs. Definition: a percentage of the value of the imported goods. Example: if a country imposes a 10% tariff on cars, and the value of an imported car is $20,000, the tariff will be $2,000, 10% of $20,000. Specific tariffs. Definition: a fixed fee charged per unit of the imported good, regardless of its value. Example: a country may charge $500 for each car imported, regardless of whether the car is worth $10,000 or $30,000. Compound tariffs. Definition: a combination of ad valorem and specific tariffs. Example: a country may charge both a 5% tariff on the value of imported cars and a $200 fee per car. On importers, tariffs increase the cost of imported goods. Importers must either absorb the cost or pass it on to consumers, raising prices. On consumers, consumers generally face higher prices for imported goods due to the tariff. If domestic alternatives are limited or more expensive, consumers may be forced to pay more or change their purchasing habits. On domestic producers, domestic companies that compete with imported goods may benefit from tariffs. The higher price of imports can make locally produced goods more attractive to consumers, leading to more sales for domestic producers. Revenue generation. Tariffs can provide a significant source of income for governments, especially in countries that lack other forms of taxation. Market distortion. Tariffs can create inefficiencies in the market by making imported goods more expensive, distorting prices, and reducing overall trade. For example, a tariff on steel imports might help local steel manufacturers, but harm industries that depend on cheap steel, like car manufacturers. Retaliation and trade wars. If one country imposes tariffs, the country on the receiving end might retaliate by imposing its own tariffs, leading to a cycle of trade restrictions. This can escalate into a trade war, reducing international trade and economic growth. Governments may impose tariffs for various reasons. Protection of domestic industries. Tariffs protect local businesses from cheaper foreign competition. For example, a country might impose tariffs on imported textiles to support its domestic textile industry. Revenue generation. Some countries with limited tax systems rely on tariffs as a major source of revenue. Political or strategic leverage. Tariffs can be used as a tool in international negotiations, sometimes to gain favorable trade terms or to punish a country for perceived unfair trade practices. National security. Some tariffs are imposed on goods deemed essential to national security, such as defense equipment or key raw materials. In recent years, the United States imposed tariffs on a wide range of Chinese goods to address issues like unfair trade practices, intellectual property theft, and trade imbalances. China retaliated with tariffs on U.S. goods. The resulting tariffs led to increased prices for consumers in both countries, disruptions to global supply chains, and economic strain on industries in both nations. Countries often negotiate trade agreements to reduce tariffs between them. For example, NAFTA, USMCA, the North American Free Trade Agreement, NAFTA, now replaced by the United States-Mexico-Canada Agreement, USMCA, reduced or eliminated many tariffs between the U.S., Canada, and Mexico. WTO, the World Trade Organization, WTO, is a global organization that facilitates international trade agreements and encourages the reduction of tariffs worldwide. In essence, tariffs are taxes on imported goods that raise their prices, benefiting domestic producers but potentially harming consumers. While they can be a tool for protecting local industries and generating revenue, tariffs can also lead to trade disruptions, inefficiencies, and economic retaliation between countries.